Let's start with a wild thought. What if our entire financial system is built on the wrong kind of physics? Well, a pretty groundbreaking thesis called Entangled Markets by Rolando Garcia suggests a totally new way to look at money, risk, and crashes. And it does it by looking at them not through economics, but through the really strange and powerful rules of the quantum world.
Okay, let's just jump right in with a pretty bold statement. Our financial system has a bug, a really big one. We see it every time there's a flash crash, one of those sudden violent market collapses where liquidity, which is the lifeblood of the system, just vanishes. For years, we've kind of just accepted these as unavoidable glitches. But what if they aren't? What if the problem is baked into the very code of classical finance itself? And here's the kicker. What if the fix, the patch for this bug, doesn't come from economics at all, but from the bizarre and powerful world of quantum physics? That's the huge question we're going to try and unpack today. So, first up, let's take a look at why the current system breaks down in the first place and exactly where our old models are failing us. This really gets us to a massive shift in how we think about things. See, classical finance views an asset's price as moving along this one predictable path. But quantum finance comes along and says, nope, that's all wrong. It suggests an asset's price isn't a single point, but a whole cloud of possibilities, a superposition of all potential futures existing all at once. Kind of like a spinning coin before it lands. It's both heads and tails at the very same time. So here's the crucial point. The old models treat liquidity, the ability to buy and sell easily, as if it has mass, it has inertia. So in a panic, what happens? Everyone rushes for the exits at once, but this heavy liquidity gets stuck in a massive traffic jam. It just can't move fast enough, the system freezes up, and that's when the market crashes. And this leads us to Garcia's proposed rewrite, to stop seeing the market as some kind of classical machine and start seeing it as an interconnected quantum system. Okay, the core idea here is the market wave function. Now, instead of a single price, just try to imagine the market holding all potential future prices and the probabilities for each one all at once in that quantum cloud. It's a complete picture of market sentiment, and it contains way more information than just one single number ever could. So you might be thinking, well, if the price is a cloud, how do we ever get an actual number? And that's where a trade comes in. The thesis argues that every single trade acts like a quantum measurement. It's like you're slamming your hand down on that spinning coin. It forces that whole cloud of possibilities to collapse into one single real thing, the price of that trade. And this happens billions of times a day, constantly defining and redefining the market state. But how do we actually fix the system? This brings us to what might be the most powerful idea in the whole thesis, a self-healing backup system that's inspired by a Nobel Prize-winning material, graphene. Remember that whole problem of liquidity having mass? Well, the solution is honestly brilliant. You just make it massless. This thesis proposes we model capital flow not as some heavy, slow-moving object, but like the electrons in graphene. Graphene is this one atom-thick sheet of carbon where electrons act as if they have zero mass. They can move at incredible speeds with no resistance. Massless liquidity could, in theory, move instantly to wherever it's needed most, even right in the middle of a crash. So how would this power field actually work? Think of it like a systemic battery that has a three-step job. First, when things are stable, it stores up excess energy from the market's own momentum. Second, it's always watching, and it can detect the unique signature of a flash crash, that sudden, catastrophic drop. And third, it instantly discharges all that stored energy as a wave of massless liquidity, stabilizing the market from the inside out. It's basically a self-correcting financial dynamo. Okay, this next part gets us to the most important philosophical shift in this entire thesis. It's all about changing the very purpose of our financial models. For decades, our financial models, even the really complex ones, have just been passive observers. They describe what the market is doing, they model risk, and then, after a crash, they help us figure out what went wrong. This framework is fundamentally different. Its goal isn't just to describe the system, it's to actively control it. It's to build a market with its own immune system, designed to prevent the crash from ever happening at all. Now, I know what you're thinking. This all sounds incredible in theory, but does it actually hold up when you look at the data? Let's check out the empirical evidence. So check out this chart. It compares the accuracy of 3 different option pricing models using S&P 500 data from 2010 all the way to 2023. The score here is root mean square error, or RMSE, which basically just measures how wrong the model is, so lower is better. The classic Black-Scholes model, an error score of 3.42. The more advanced Heston model gets that down to 1.87, but the quantum model with the graphene gain, it's all the way down at 0.93. I mean, that's not just a little bit better, it's more than twice as accurate as its closest competitor. That's a huge deal. And now for the ultimate stress test, a simulated total liquidity blackout. At time zero, the blackout starts. Just 45 seconds later, a singularity forms. Think of it as a market black hole where trading just stops, and the risk score absolutely skyrockets. But watch this. The power field kicks in, discharging energy. Then, the graphene gain activates, amplifying the recovery. And by the 2-minute mark, the system has stabilized itself. The blackout was survived. So, what does this all really mean? If a system like this can actually be built, it doesn't just change how we trade. It changes the entire nature of finance itself. Let's just summarize what this all adds up to. We're talking about markets that can literally heal themselves, almost like a living thing. It would transform regulators from being like traffic cops who just show up after an accident into pilots who are actively stabilizing the system in real time. It imagines capital that can flow without any friction, and, at the end of the day, a financial system built not on old economic assumptions, but on the fundamental laws of physics. And that brings us to one final, really provocative thought. The goal here isn't just to build a better stock market. The real question this thesis leaves us with is this. If we can apply these principles to create self-healing financial systems, what other huge, fragile, complex systems in our world could we redesign next?